All right, if you care about markets, you need to hear this right now. In the last 24 hours, silver didn't just dip, it fell off a cliff. We're talking about a minus 21.5% move from roughly $120 an ounce down to about 97. And in that single day, around $1.4 trillion dollars in market value just vanished. Not over months, not over weeks, in hours. And here's the part most headlines are getting wrong. The real trigger isn't collapsing demand, it's leverage imploding. Both futures market data and physical pricing out of Asia confirmed this almost simultaneously, and that's why this matters to you. Stay with me because I'm going to show you what just happened, why it keeps repeating, and how you can spot this pattern before the crowd next time. Now, before I explain what caused this, let me teach you something most people never really understand about markets. When you see a price go vertical, especially in something like silver, you're not just seeing buyers, you're seeing borrowed money piled on top of borrowed money. Think of it like stacking chairs during a party. It looks fine until one person bumps the stack, and then suddenly every chair is falling at once. That's leverage. It amplifies gains on the way up, sure, but here's what they don't tell you. It forces selling on the way down, whether people want to sell or not. And here's the key thing you need to remember. When leverage breaks, price moves faster than fundamentals ever could. You've probably heard the term margin call before. What that actually means is your broker's saying, hey, you don't have enough cash to back up your position anymore. Put up more money right now. Or we're selling your position for you. And when that happens across thousands of accounts at the same time, that's when you get these absolutely violent moves that make no sense if you're just looking at supply and demand. So, what does that tell us? It tells us that not all sell offs are created equal. Some are about fundamentals changing, some are about the mechanics of how positions are funded. And if this is making sense, drop a comment below because we're about to go deeper. So, here's what's actually happening. Let me break down the sequence for you because this is where the lesson is. Silver had gone parabolic. I mean, truly vertical on the charts. As price pushed through $100, speculative leverage exploded in futures markets. Everyone and their cousin wanted exposure. Margins got tighter, liquidity got thinner, and everyone felt rich on paper. Then price stalled. That's the trigger. When price hesitates at extreme leverage, margin calls start firing. It's not complicated, it's just mechanical. When margins are hit, traders don't get a choice. They sell. That selling pushes price lower, which triggers more margin calls, which forces more selling. That's the cascade. And once it starts, it feeds on itself until the leverage is flushed out of the system. Now, here's what makes this move so interesting, and why I'm telling you this is about mechanics, not fundamentals. At the exact same time, paper silver was collapsing on futures exchanges, physical prices in China stayed elevated. Premiums didn't break, supply didn't loosen. You had dealers in Shanghai still charging 25% premiums over spot. If this were a true demand collapse, you'd see physical buyers disappear. They didn't. You'd see premiums collapse. They didn't. You'd see metal flood back onto the market. It didn't happen. So when you see paper prices reset violently while physical markets stay tight, you're not watching fundamentals fail. You're watching leverage flush out. That divergence is your confirmation. It's the signal that tells you what kind of move this actually is. But here's the part that should make you nervous and also focused. Most people panic at this stage right when the mechanical selling is peaking. They see the price crater, they see red everywhere, and they assume something must be fundamentally broken. But if you understand what's actually happening, if you can separate forced selling from voluntary selling, you're already ahead of 90% of market participants. Because forced selling has to end. It's finite. There's only so much leveraged position that can get liquidated. And when it's done, when the last margin call is met, that's typically when you see stabilization. Not because suddenly everyone loves silver again, but because the selling pressure that had nothing to do with value just exhausted itself. Now, let me show you what very few people are talking about. The open interest data. Open interest is basically the total number of active futures contracts. When you see open interest dropping while price is falling, that's liquidation. That's positions getting closed, not new shorts piling on. And that's exactly what we saw. Open interest collapsed alongside price. That tells you this wasn't a wave of new bearish bets. This was existing longs getting forced out. There's a massive difference between those two scenarios. And if you can read that difference, you've got an edge most people don't have. This is the exact same playbook silver has followed before, and I want you to see the pattern clearly. In 2008, silver got obliterated during the liquidity crisis. I'm talking about a 50% drawdown in weeks. Everyone said silver was dead. Physical markets completely dried up. You couldn't buy coins anywhere. What happened next? Silver rallied hundreds of percent over the following years. In 2011, a parabolic run ended in a brutal margin-induced crash. Silver went from nearly $50 down to the low 30s in a matter of days. Not because silver was suddenly worthless, but because leverage had gone too far. Same pattern: forced selling, physical tightness, and then a reset. March 2020 did the same thing. Pandemic hits, liquidity freezes everywhere, and silver got hammered. Meanwhile, you had coin dealers completely sold out, premiums going through the roof, and paper price at 18 bucks. A violent paper sell-off, physical shortages everywhere, and then a powerful continuation once forced selling exhausted itself. When you zoom out and look at the pattern, you see it clearly. Extreme leverage builds, a shock hits, paper prices collapse, physical markets hold, then price resets and reprices higher every single time. The larger story here is that these events tend to mark inflection points, not endings, and you've seen this movie before if you know what to watch. The script doesn't change, only the year does. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep falling? Absolutely. Could sentiment stay ugly longer than you expect? Yes. Could we see $90? Could we see 80? It's possible. And here's the thing about manipulation narratives. I see them everywhere in the comments. They're emotionally satisfying, but they're not actionable. You don't need a villain to explain this move. The mechanics explain it cleanly. Leverage built up. Price stalled. Margins hit. Forced selling cascaded. That's it. So instead of arguing about intent, instead of debating whether some bank somewhere is suppressing price, focus on what you can control. Watch liquidity. Watch leverage. Watch physical signals. Those don't lie, even when price does. You can trade a conspiracy theory, or you can trade the actual mechanics. I know which one I'd rather bet on. There are probably three types of people watching this right now, and I want to talk to each of you directly. First, you're holding silver and you're stressed. Maybe you bought at 110. Maybe you've been stacking for years and you're watching your portfolio bleed. You're staring at your screen, wondering if you missed something fundamental. If that's you, take a breath. Understand what you own, understand why this move happened, and don't confuse forced selling with broken demand. If you bought silver because you believe in the long-term case, because you're worried about currency debasement, because you think precious metals are insurance, then what changed? Did the money printing stop? Did debt levels suddenly become sustainable? No. What changed is that a bunch of leveraged speculators got wiped out. That's not your thesis breaking. That's noise. So zoom out. Remember why you're holding. And if you're sick to your stomach because you're over leveraged yourself, well, that's a different lesson. And it's one worth learning now. Second, you're on the sidelines and you're thinking, should I even care about this? Maybe you don't own silver. Maybe you're just watching because it's dramatic. If that's you, this is your education moment. You're learning in real time how fast leverage unwinds and why patience matters. You're seeing what happens when everyone's on the same side of the boat and the boat tips. This applies to crypto, it applies to stocks, it applies to real estate when enough borrowed money is involved. The lesson isn't specific to silver. The lesson is about risk, about position sizing, about understanding the difference between price and value. So, yeah, you should care. Not because you need to trade silver, but because this pattern shows up everywhere, and next time it might be in something you do own. Third, you're actively trading and you're tempted to call a bottom. You're looking at this and thinking, okay, oversold, time to buy. If that's you, remember this. Bottoms aren't about bravery, they're about confirmation. Catching a falling knife feels amazing when it works, and it's brutal when it doesn't. So if you're going to step in, do it with your eyes open. Don't use leverage to buy a leverage collapse. That's insane. Don't bet the farm on a reversal just because it feels oversold. Scale in. Watch for stabilization. Wait for the signs that forced selling is actually done, not just paused. And for all of you, the universal principle is the same. Price alone isn't the signal. Context is. Understanding what's driving the move is what separates guessing from analysis. So here's where I stand, and I'm going to be very clear about this. I'm not panicking, and I'm not blindly bullish either. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone. That's where stabilization usually starts after a leverage flush. If silver can hold in that range for a few days without another leg down, that tells you the worst of the forced selling is probably behind us. Second, I'm watching Shanghai premiums. If they stay above 20%, that tells you physical tightness isn't easing. That tells you real demand didn't collapse. Third, I'm monitoring open interest. If open interest keeps falling while price goes sideways or starts to recover, that means forced sellers are gone and the market's cleaning itself up. Those three things together will tell you more than any price target or chart pattern ever could. Based on my analysis, this event was mechanical, not emotional. It was structural, not fundamental. The fundamentals didn't break. The case for silver, whether it's monetary, industrial, or just portfolio diversification, that case didn't change because of a margin call cascade. What changed is that the market had gotten ahead of itself on borrowed money, and borrowed money got called in. If history rhymes, and I think it does, this kind of reset tends to clear the path for the next move higher. It shakes out the weak hands, it flushes the leverage, and it creates the kind of washout that sustainable rallies tend to build from. Now, I'm not sitting here telling you silver's going to $200 next month. I have no idea. But I do know that the conditions that make silver interesting longer term, those haven't gone away. And I do know that violent deleveraging events tend to mark bottoms, not beginnings of multi-year collapses. I'm not a financial advisor. This is not financial advice. Everything I just told you is my own analysis and my own opinion. Do your own research. Make decisions that make sense for your situation, your risk tolerance, your time horizon. Don't trade on emotion. Don't panic because everyone else is panicking. And definitely don't borrow money to chase anything up or down. If you made it this far, you're thinking critically. You're not just reacting to headlines, you're trying to understand the actual mechanics of what's happening. That mentality will serve you well, not just in silver, but in every market you ever touch. If this breakdown helped you see the situation more clearly, share it with someone who needs to hear it. Hit subscribe if you want more analysis like this, and drop a comment telling me what you're watching right now because I want to know where your head's at. Stay sharp out there. Think critically, verify your data, and make decisions that make sense for you.